Hello and welcome to the Financing a Sustainable Future podcast, brought to you by the Initiative in Sustainable Finance, funded by the Global School of Sustainability here at LSE. I'm Tom Gosling, Professor in Practice and Director of the initiative. This is a podcast where we talk to LSE academics about their research on sustainable finance in a way that is accessible for practitioners. I'm delighted to be joined today by Yang Guo to discuss her working paper, Leverage, Engagement and Welfare in Decentralised Financial Markets. Yang recently completed a PhD in the finance department here at LSE and will shortly join the Department of Economics at the University of Bonn as a postdoctoral research fellow. So Yang, welcome to the podcast.
Thank you very much for having me, Tom. I'm very happy to be here.
Yeah, it's great to have you. And your paper starts with a really simple, important question. Can financial markets help solve real economy problems such as underinvestment in the green transition? And can they do this even when investors are solely focused on financial returns? What drew you to that question, and what is the gap in the literature that you're trying to fill?
So I think I started by looking at what is happening nowadays, and I think we all agree that the green transition is something that we actually need. But year after year, the news has been telling us there are some delays, and we have been, struggling to meet the Paris goals, etc. So why could potentially cause delays? I think one explanation is that it is like a theme that has been coming up, on this podcast before, which is the very classic free riding problem. So the transition itself is very costly because this is like public goods. Everyone benefit from it, everyone benefit from clean airs, more stable climate. Everyone has a temptation to wait for someone else to pay for it. And at the same time, people have been looking for solutions from the financial markets. And one of the promising candidates is what we call these mandated funds. So these mandated funds invest in the firms and engage with the management and help maybe lower the barriers for the firms to go green. But this is exactly where the free riding problem bites in. So the funds comes in with a very good mandate, but it's the question why these investors are actually happy to put money into these funds. Because, every shareholder is going to enjoy the benefit of that, and these engagements are costly, so the mandated fund has to charge a fee to finance these operations. So as an investor, if I'm purely return-driven, it is not very clear for me why would I ever want to put money into this costly fund when there are some other funds options available on the market where I can always enjoy the benefits, without paying this cost. So this is the puzzle that actually, drives me into these questions. And I think these days in these markets, there are a lot of, ordinary and small investors when they make their investment decisions, return is the first thing they look at. So if everyone are something like this, like small, who is going to pay for these engagements? And can this mandated fund sector, remain viable given these conditions? And if so, what kind of, conditions we need to make this happen?
So let's just dig in a little bit more to the specific problem that you're studying. So why do firms underinvest in innovation or socially valuable transitions in the first place? And what's the sustainable finance channel related to this that you're exploring?
So the friction actually starts in the products market. So let's imagine that we have an industry and the consumers actually have a preference for the green version of the products. And I think there have been survey articles showing that this is true, that consumers are actually happy or have the willingness to pay for these green products. At the same time, the firms can choose to produce either the green type or the brown type of products, but producing these green type of products, they have to pay for a one-off transition cost because they have to retraining the staff, redesigning the production process, or to meet some new industry standards. And here's the catch. So in any kind of markets, if the market has certain level of competitions, the firm can actually never capture the full values the consumer place on these green products because competition will always drive the price down. So only a slice of the benefits or the value can be captured by the firms, but they have to pay the full transition cost in this industry. As an outcome, only a fraction of the firms in an industry is going to choose willingly to produce these green products. And if we have a social planner, or if we stand on social view, we look at this, actually, if all the firms producing the green type of products is actually good for the society because the consumer actually have the demand for it. So this is the gap, or this is the externality problem that I wanted to solve in this model, or I want the financial markets to help to solve this. And I think one interesting feature actually coming out of these products markets, which is let's consider a scenario where we have this one mandate fund, and the fund is going to invest in one of these traditional firms or these brown firms that try to turn these firms into green. Now, what is happening in this product market is that the profit margin of these green firms is going to get squeezed, meaning that the profit for green firms is going to be lower compared to the brown firms. So actually, when one firm's turning into green, there will be one green firm actually want to turn to brown or to switch back to the traditional firms now, because now producing the traditional type is actually more profitable. So kind of the key message here is that if we're converting one firm at once, it's just about reshuffling who is green in these markets without actually changing the totals or without actually changing, the total level of green production in this market. So the question is not really about can mandated funds green one firms, and it surely can in theory. It is more about can this mandated fund sector green the whole industry than actually improve the welfare. And this means that this engagement has to happen at a large scale as such that we can actually experience welfare improvement.
So one conclusion from this would be that actually what you need is activist investors with social welfare objectives to be the answer. And indeed, that's a conclusion from another recent paper from Professor Martin Umke that featured on the podcast just recently. But one of the findings in your paper is that activist funds on their own don't solve the problem. And is this connected to this fact that the green and the brown firms just sort of shuffle around, or is there something more to it?
Yeah, sure. That's actually one of the key points here. I think the short answer to the question is that it will go back to the free riding problem that I sketched at the start. So these mandated funds, come into this market having these good intentions, and they want to, fix the externality problem. But what actually matters is that who is going to put money with them, and if nobody for the return-driven investor don't put money into these funds, the funds cannot really remain viable, and we cannot really achieve welfare improvement. And I'm very glad that you mentioned Martin's work here, because I think it is definitely one of the papers that laid the foundations of this literature. And what I wanted to say is that actually we are trying to solve the same problems. We're trying to answer the question, what are the conditions that needed to actually make this mandated fund sector remain viable? And I think in his framework, the solution is coming from the investor side. That investor needs to, when they're making the investments, they know that they're doing something good. And they, from a moral point of view, that I put money with you and this is good for me. And or there's something closer to, in the economics literature, called the warm glow utilities, where you feel good by doing good. I think these actually solve the trade-off or the free riding problems here, because that gives the incentive for the investor to invest with a mandated fund. And I think in my paper, I'm starting from a very different angles here, where instead of looking at the investors, I say, can the financial market structure helps here? And to do that, I intentionally keep the investor assumption as simple as possible, just to say they're just return-driven. And I think in today's markets, there is still a significant amount of money from investors who are just small, who are not really fully aware of the sustainable investing itself, and who only just wanted to care about returns. And this gives me the idea of a clean, stress test. And in a scenario where nobody actually have the social motivations at all, either something left in the structure of the financial market that we can do can actually help, the structures to work. So I really think that my works and Martin's work and the previous literature are all trying to, find solutions and how we can, make this impact investing works. And in the realistic world, I think both of them could work. We just look at the problem from different angles.
So you're kind of, in a way, holding different things constant. So, in Martin's paper, he holds kind of constant the supply of kind of profit-seeking capital so that, sustainable funds don't shift the cost of capital.
Yep.
In your model, you're holding constant the fact that people are return preference-seeking investors.
Exactly.
And so we just get another window on the same problem through your work. And actually the novel step in your paper is introducing households who save through bank deposits rather than investing directly in markets. And on the face of it, that seems like a totally unrelated factor. So how does it become related to this question that you're looking at and end up actually changing the outcome?
Yeah, so in reality, a large share of household money never really touched the stock markets. So some of households face participation costs, and some simply just prefer to, hold cash. And so they leave this money into the bank and earn very little interest rate. And economists sometimes call them like sleeping capitals. So what my model is trying to do is that to make the sleeping capital actually being productive or useful in a way. I think the banks here is just another layer of financial intermediaries where it creates these channels to actually take the deposit or the saving from the households and put that into these fund sectors. And that's the whole channel. And I think you can also picture something similar in today's markets where some of the households actually invest or put the money in, let's say, these money market mutual funds. And these funds get lent onwards through these short-term funding channels, and some of them actually end up in the financing leverage of the funds. So what I wanted to emphasize, what I wanted to show is these channels where we can channel the money from the households to the funding sectors. And how does this actually solve the problem in my model? So these mandated funds is going to earn the management fees from the investors who invest with them. And from the fees that they charge from the investors, a part of them is going to pay for the interest rates that the bank is going to charge on them. Partially is going to be used to finance these engagements and turn the firms into green activities. And from the investor's point of view, so once the fund receives the money, they will invest the money along with the leveraged money they borrow from the banks. And once there's a returns, they will actually return the whole thing to the investors. So from the investor's point of view, actually now the leverage return is actually higher for me. So these give the investors the incentive to put money with these mandated funds, because now the return is higher. When the investors are making investment decisions, he or she will think, oh, actually, this mandated fund returns are actually not that bad in this case. And if I'm a return driven, I'm actually happy to give the money into this fund. And I think there's also a very natural amplifier here where to address the issue that we talked about at the beginning, that engagement has to happen at a scale. So the fund industry itself can be like a free entries, right? So once these mandated funds receive investments, they charge the fees. If there's any kind of profit through this process, there will be free entry. There will be more mandated fund entering this market. So the sector starts to grow. And once the sector starts to grow, there will be more firms getting invested by these mandated funds. So there will be more or higher chances of these firms are going to be green as an outcome. So that's how these leverage and engagement help in total through this process.
So, are the bank deposits, in a way, providing some sort of implicit subsidy to these green funds? Is that what's going on here?
Yes, so I would think about this as in, so no one in these markets actually needs to do something different. So these households already, households already save the money to the bank. So they're not going to do anything additional. And these saving actually in the way to subsidize the returns that are required from the investors from the market. So I think the households, since they have participation constraints or, liquidity preference, they can't really, utilize this money, let the money to go somewhere that is more productive and help the society, yes.
So if we put all this together, what's the central message of the paper? Under what conditions can activist investing actually improve welfare, even when nobody in the model is motivated by social goals?
Yeah, so exactly that we can maybe go back to the free riding problem that we addressed at the beginning. It is about what happens when every investor in the market is purely return driven and how we're going to solve this problem. So I think my kind of key message here is that we can change the architecture of the financial markets. And as I mentioned in the model, no one is actually changing what they're doing. So households just keep saving in the way that they are doing right now, and investors keeping chasing the returns and what they always do. But the system just creates kind of routes to route these household savings into the leverage for these mandated funds, and this engagement will happen itself. And I think what kind of condition we need for this work. So first of all, this channel is very important, that we need to have this channel for the funding to go through. And I think second is that we need this mandated fund to actually be able to charge fees to the investors. So these fees are very crucial for the funds to actually, first of all, pay the interest rates from the bank lendings, and second, to finance the engagement. So I think that's what we need through this process, the channels and the fees that the mandated fund charges through this process.
So what do you think this work that you've done adds to the debate about the role of sustainable investing in generating real-world impact?
I think, the literatures or the debates is fundamentally about who is going to pay for these transitions. The literature has given us a very good answers, which is, the investors with these social preferences going to, pay for these transitions. When these investors exist, fantastic. That's how we are going to solve this. But I think what I want to show here is that, even if these investors don't exist, we can still have solutions through these banking channels, through the deposits that we have, and through these kind of deposit subsidizing in a way that you mentioned before, where we can still achieve these welfare improving outcomes. And here, the way that we finance through or who pay for this engagement is actually through these banking channels, and the deposits our households who are saving are actually a crucial role that they're playing in this market to pay for these green transitions.
What I found fascinating about this paper, and when I put it alongside Martin's paper and another paper we'll discuss next academic year that Emil Dasgupta has been doing with co-authors, is that we it seems to me, need to look at sort of sustainable investing as a system, right? And we tend to kind of focus in on individual kind of funds and the nature of individual funds, but you're showing that actually it's how this all sits within a system that really counts. And so are there implications for policymakers from your findings, would you say?
Yeah, so I think one key findings or implications from the policy point of view is that we need to encourage the money to do something good on itself. Here is that we need to create these channels for the households to have the money, slipping deposit and going to the engagement sector to actually let them to make some impact here. And I think this is not just, imaginations. So I think in the private equity sector, they have been taking out credit facilities for their ESG goals. So I think this channel already exists, but somehow it lives in the private market these days because these private equity investors, it's really like a small circle of institutions. So the question is really about how we can, enlarge these circles and having more investors participating into these transitions, and to create the skills and allow people to engage further to actually create the scale of the engagement we needed for the green transitions.
Well, Yang, it's been great to talk with you today. I mean, I think this is part of a really important body of work that's showing, how can we harness markets towards the transition, and given the struggle that policymakers are having to put their thumb on the scale, I think that's really important. It's been great having you here at LSE. We'll be sorry to lose you, but best of luck in Bonn, and thank you very much.
Thank you very much for your time. Thank you.
You've been listening to the Financing a Sustainable Future podcast with me, Tom Gosling. If you enjoyed the conversation, please like, share and subscribe on your favourite platform. To find out more about the work of the Initiative in Sustainable Finance, which is funded by the Global School of Sustainability here at LSE, please go to fmg.ac.uk/ISF.